There are two elements of tax. One is called the current tax, that is the amount of tax payable or recoverable in respect of taxable profit or loss for a period. Now payable is when you have to pay, recoverable is when there is a refund due, or in some cases like in US and all, there is also provision of carryback. So like for example, previous year you paid tax, current year you have a loss, you can claim refund. Okay, that's a unique thing which I've seen in the US accounting or US tax laws, where you can actually claim back the taxes that you have paid in the previous year because you have losses now. Okay, in India we don't have any such kind of concept. This is only a carry forward thing, no carry back, right? Then deferred tax is what? Is an accounting adjustment to match the tax effect of transactions to the relevant accounting period. This is slightly a complicated way of explaining. The best way to understand is it is basically an accounting adjustment to match the items of accounting income and the tax component. Okay, so whatever goes into accounting income, that you have to compare or that you have to see and ensure that corresponding tax effect is also taken care of, right? Now, current tax, deferred tax. Now this deferred tax can be plus or minus. Okay, so deferred tax plus current tax gives you tax expense. So when we say tax expense, we are referring to current tax and deferred tax. Now how should we pass the entry? For current tax, credit tax payable. Okay, so here in this case first year 87,500, tax payable 87,500 because that is what you will pay. And for deferred tax, debit deferred tax expense 5,000, credit deferred tax liability 5,000. Okay, so the total expense will be current tax plus deferred tax put together. If there is a benefit, if there is an asset, then current tax minus deferred tax benefit, right? So let's look at this. Now this is one chapter where we will be focusing more on the questions, because concept wise, or the way to understand the concept is best to understand with the help of problems. Okay, Simple has estimated income tax liability for the year ended 31st December of year 8 at $180,000. In the previous year, the income tax liability has been estimated as $150,000. Calculate the tax expense that will be shown in the statement of profit and loss for the year ended 31st December of year 8 if the amount that was actually agreed and settled with the tax authority in respect of year 7 was 165 and 140. Now here two things. Opening balance we have of income tax payable. Opening balance is how much? 150. Okay. Now actual tax paid out of above is how much? There are two scenarios, 165, and in the second scenario it is 140. Okay. Now when I had provided for 150 earlier, but now actually I have to pay 165, is this an under provision or is this an over provision?
Under provision.
Right, that is an under provision. Why? Because we have now actually paid a higher amount. In the second case, it is a in the second case it is a over provision, right? So there are two scenarios that we have seen here, under provision and over provision. Now in the previous year you would have passed debit income tax expense 150, credit income tax payable 150, right? Now while settlement, what is the entry you will pass if you have paid 165? Think of it.
Income tax payable to cash.
Income tax payable to
bank.
Income tax payable by what amount?
160.
See, if we come back to the question, Previous year liability estimated is 150, actual paid now I am saying 165. Think, no need to hurry. Where will you take the difference?
Tax expense only.
So what you'll do is income tax payable I have 150, credit to bank is 165. So the difference is my expense. So debit income tax expense, difference between these two, and this income tax expense is also considered to be current tax expense. Now don't think, sir, this was tax expense of previous year, why are we saying current tax? Because this is something which is not a deferred tax. Okay, so all of the tax expense which you are paying as per the tax provision is current tax only. So you will take it to income tax expense 15,000. Then current year debit income tax expense how much is that? 180. Credit income tax payable 180. So what is the total tax expense? Total tax expense is 180 plus this 15, which is 195. Okay, you can directly calculate. I am just showing the journal entry so that you understand the flow. Otherwise, you can simply say previous year 150, actual paid 165. So income tax expense or benefit, this minus this is an expense, and if you pay less, it becomes a benefit, right? So that is how we calculate. Year end estimate 180 plus under provision with respect to year 7, 15, total becomes 195, right? In the second case, just reverse scenario. What is the scenario? In the second case, the scenario is income tax payable 150. Oh, I cannot write here, I have to. Okay. Then credit bank 140. The difference between these two, 10,000 is actually credited to income tax expense. Okay, current year it remains same. So here the expense will be 180 minus 10,000, 170. Clear? Just a second. Right. So coming back, we have understood about current taxation. Current taxation is tax payable based on income tax provisions, and it's a simple thing. Okay, and most of the cases you will not get only questions based on current tax. It will be current tax plus deferred taxation. Right. Now moving on to the next part, which is the core of the standard of IAS 12, that is deferred taxation. Now, as I explained you, deferred taxation is basically to take care of mismatches between accounting income and tax income. So there would be a mismatch, or there could be a mismatch between accounting income and tax income, and for that we will use deferred taxation to take care of differences between these two items. Okay. So what is a deferred tax? As we have understood in the example that we have taken earlier, deferred tax is estimated future tax consequences of transactions and events recognized in the financial statement of the current and previous period. So if we go back to our example, in the first year depreciation was 30,000 as per accounting records. As far as tax laws are concerned, the depreciation is 50,000. So here there is a mismatch. Now because of this mismatch, you are paying less tax today. So the current tax goes down. But then it is not a permanent benefit. Today you have paid less tax. In this year you have paid less tax. In the future period you have to pay higher tax. So when you have to pay higher tax in the future, there is a liability. So that is what gets captured as a deferred tax liability. Correct? So it is the estimated future tax consequence. So how did we estimate? Depreciation, accounting, taxation. Accounting depreciation was 30,000. Tax depreciation is 50,000. Difference is 30 minus 50, which is 20. Now for this 20,000, or because of this difference of 20,000, we will have to pay higher tax in the future. So there is a future tax consequence, and hence there is a deferred tax liability at our tax rate of 25%, which is 20,000 into 25%, 5,000, right? So that is how deferred taxation works. So again, it is the estimated future tax consequence of transactions and events recognized in financial statements of the current and previous period. So we have understood that there is something called as accounting profit, which is as per your books of accounts, and there is something called as taxable profit, which is for the tax purpose, right? Now, there would be differences. There would be differences between accounting profit and tax profit, and because of these differences, there is a tax consequence which is called deferred taxation. Now, moving on, few scenarios. Okay. Say for example, we have profit before tax 100,000. Okay. And this is accounting, and there is a taxable profit. Okay. And between this accounting profit and taxable profit, there would be some adjustments, which you understand as a part of the relevant tax laws of the country which you would be working for, correct? Now, profit before tax is 100,000. It is not always necessary that income tax would be paid on 100,000, right? There could be multiple scenarios. One of that, what we have understood, is depreciation. The other one that we are understanding, or that we would be understanding now, is with respect to some other differences called as permanent difference. Now, what is this permanent difference? Say for example, while calculating this profit before tax, there is a expense related to penalty. There is an expense related to penalty, which is 5,000. So when we calculated profit before tax of 100,000, we have deducted 5,000 of expenses on penalty, which the tax laws say it cannot be. What is the meaning of this? I have deducted 5,000 to arrive at 100,000, but then tax authorities say penalty cannot be deducted to calculate taxable profit. So if penalty cannot be deducted to calculate taxable profit, what will be my taxable profit? This 5,000 I cannot deduct. I have already deducted, right? 5,000 I cannot deduct. I have already deducted. So now what I have to do? I have to add back the 5,000. Why? Because tax authorities say, or tax laws state, that you cannot deduct this 5,000. So if I cannot deduct the 5,000, I have to add back 5,000. So what will be my taxable profit? That will be 100,000 plus 5,000, 105,000. So this is something we call expenses disallowed or not deductible for tax purpose. Now, if something is not deductible for tax purpose, will my tax payment, or will my tax expense be higher or lower?
Yes.
It will be higher, right? So I have to pay higher tax. Now tell me, will I get any benefit out of this in the future? Will I be able to claim this as a deduction in the future?
No, sir.
So there is a penalty related expense which I am not able to deduct neither in the current year nor in the future period. That is called permanent difference. Meaning to say, these kind of differences are permanent. There is no question of deferred tax angle for this, because neither it is allowed today nor it will be allowed in the future. So permanent differences do not create deferred tax impact. Now another example could be, these are independent examples. Okay, there is an income which is exempt from tax. Say there is 10,000 of income expense exempt from tax. Now exempt from tax means there is no tax implication. You don't need to pay tax on this exempt income, though you will say it's a profit, but you will not pay taxes. Now when you not pay taxes on 10,000, you will say minus 10,000 and your taxable profit becomes 90,000. Now here, when you pay tax on 90,000, it is of course lower, because 10,000 of profit is not taxable, correct? So when 10,000 of profit is not taxable forever, you have to pay lesser tax. Then, sorry, Then, is there a need to pay tax in the future on this exempt income? You don't have to pay. Today also you don't need to pay tax. In the future also you don't need to pay tax. So when you don't have to pay any tax, when there is no tax implication, that is also a permanent difference, right? So here also this is a permanent difference because it is an item which will never be taxed from the point of view of income taxes. So permanent differences are those differences which will never reverse in the future, like in case of depreciation, unlike in case of depreciation. In depreciation, if you see 30,000, 30,000, 30,000. So year 1 higher depreciation, year 2 higher depreciation, year 3 lower depreciation. So here there is a reversal, so it is a temporary difference, right? So coming back, a temporary difference arises when an expense is allowed for both tax and accounting purpose, but within different accounting periods. So you allow something in year 1, you allow something in year 2, that creates a temporary difference, right? So if I give you few more examples for temporary difference, this is also sometimes referred to as timing difference. So this happens when allowed in, so let us say accounting, tax, income, okay. So examples could be, there is an income for accounting purposes on accrual basis. Tax says we will tax on receipt basis. Accounting says accrual basis, tax says receipt basis. If you have received in first year, offer it for income tax in the entire amount in the first year itself. For example, I am just giving an example, okay, 2 years lease rental. Tax says the entire 2 years lease rental, 2 into 100,000. 200,000 you have to tax. In which year? This will be year 1. Accounting we say 100,000 in the current year, and in year 2 100,000 in the subsequent period, right? So in year 1 100,000 was offered as income, but for tax it was 200,000. So there is a difference. Now the difference, if you see, first year higher tax payment, second year lower tax payment. Okay, this is what is called temporary difference. Accounting period, in the accounting income it is taken in one period, in the tax it is taken in another period. That is what creates the temporary difference, right? Now say there is a payment to statutory authorities. Year 1 amount payable was 50,000. Year 2 actually paid 50,000. So it is an expense pertaining to year 1, but it is actually paid in year 2. So what tax authorities may say, it depends again on the tax laws, what they may say is, this 50,000 we will allow as a deduction only in a particular year, that is in the year of payment and not in the year of accrual. So here on accrual basis you will take it up. For tax it is payment basis. Difference arising in one period, reversing in subsequent period, this is what is called temporary difference. So there are two types of differences between accounting and tax income. Permanent difference, differences which never reverse, there is no deferred tax impact. Temporary difference, differences which reverse, there is deferred tax impact, right? Now what the standard says is, temporary differences are differences between the carrying amount of an asset or liability in the statement of financial position and its tax base. Now what is the meaning of this particular item? So far we have taken individual items of income and expenses, and I have explained you how deferred tax can be computed, how current tax can be computed. Now for the purpose of IAS 12, they use the concept called balance sheet approach, where we have to see the carrying amount of the asset as per financial statements and the tax base. Now for that, let us again go back to our first example. I'll do the same thing here. We'll take the components of this particular example only. There is an asset, accounting, tax. Okay. So asset cost 100,000, 100,000. Depreciation for year 1, we said 10,000 of residual value, if I am not wrong. Yeah, 10,000 of residual value, 30,000 of depreciation. So, year 1 depreciation is 30,000. For tax, depreciation is 50,000. Carrying amount year 1 is 70,000 and 50,000. Right. Now, this 70,000 is called the carrying amount as per the financial statements, and this tax base is called the carrying amount as per the taxable income computation is called the tax base. And what is the difference? 70 minus 50, 20 is the difference. Why has this difference arisen? This difference has arisen because of depreciation. Okay, so the accounting base or the accounting carrying amount is the amount as per the financial statement. Tax base is the amount of the asset for the purpose of taxation, right? Then depreciation of year 2 is again 30,000. Here it is 50,000. Carrying amount at the end of year 2 is 40,000 here and 0 here, right? What is the difference? 40,000. 20,000 of year 1, 20,000 of year 2. Then depreciation for year 3, 30,000, 0. Carrying amount 40,000 here, 40 minus 30, 10,000 here and 0 here. The difference is now 10,000 only. So, this is how you will calculate the tax base and the accounting base, and you will calculate the deferred tax impact. Now, I want all of you to pay attention and understand one specific concept, which is when I say my carrying amount is 70,000, what does that mean? That means that in the future, I will depreciate this to the extent of 70,000 or depreciate and subsequently sell. So, entirely 70,000 will be consumed, and that would be my expense part in my income statement, correct? Whereas tax part says only 50,000. So, when I say tax base is 50,000, what it means? In the subsequent period, I will get deductions to the extent of 50,000. So, what are we saying? In the future, how much of accounting deduction will you get and how much of tax deduction will you get? When you compare that, that will give you the deferred tax liability or deferred tax asset. I am repeating once again, 70,000 is the carrying amount. In the future, I will depreciate it, or I will get depreciation of 70,000, or in this case, 30,000 and 30,000 of depreciation, and 10,000 of the 10,000 would be my cost of machine sold for calculating gain or loss. Here 50,000 is my carrying amount. Here 50,000 is my tax base. Means what? In the future, I will get deductions of 50,000. Right? Same way, if I extend that to, let us say, expenses incurred in year 1, accrual basis 50,000. Actually paid in year 2, year 1, 30,000. And year 2, 20,000, right? Tax loss allow deduction on payment basis only. Tax loss allow deduction on payment basis only. Now here, what is the expense for accounting?
50,000.
What is the expense for tax?
30,000.
Right. So, expense for accounting is 50, expense for tax is 30. What is my liability that is payable for accounting purpose?
50,000. 20,000.
At end of year 1. Payable is how much?
20,000.
20,000. For tax purpose, how much is payable for this particular expense? Think, I'll just plug in the charger. If you get this concept, half of the part is done. What is the amount payable for the purpose of, or in the books of tax? If I maintain separate books for tax purpose, what would be my liability or payable?
0.
Everybody clear with why 0? Soumya, if you want to type, you can type in also in the chat box. I understand this, first class and you missed the initial 10 minutes of thing, but where are you confused? Like, are you confused in this particular example? And please feel free to ask because, this is the first time you're attending our live class. So, is this where you have a doubt in this particular area what we have discussed, or generally you are confused with deferred taxation? Then in that case, what we can do is, as we do more questions, as we take up the concept slightly in deeper, there I'll also try to cover up more aspects which will help you. So, in this particular example, is there any doubt? Okay. Now, coming back to this example, we'll redo this also because of that connection issue also, there was a break. Okay. Expense incurred in year 1 on accrual basis. For example, I have to pay bonus to my employees. Okay. The accrual basis expense is 50,000. Out of that 50,000, I have paid only 30,000 in year 1. Paid means actually paid by cash or bank. Now, in my books of accounts, what would I say? I would say expense is 50,000 in the P&L. Liability is 20,000 because I have paid only 30,000 in year 1. Balance 20,000 is payable. This is my carrying amount of liability. So, carrying amount of liability is how much? 20,000, right? That's the first part. Now, when I prepare my financial statements, the amount of expense that I will charge is 50,000. I would say expense is 50,000. So, I'll charge expenses of 50,000. But what is the tax law talking about? Tax law says the expense can be claimed only if you have paid the expense. So, for tax purpose, what they say is, if I have paid 30,000 in year 1, then in year 1, I can claim expense of 30,000 only. So, as far as tax is concerned, if I maintain a separate books of accounts for the purpose of tax, as far as tax payments are concerned, they would say payment of bonus as an expense is 30,000 only. Is there any expense payable as far as tax is concerned? Because here tax says deduction allowed on payment basis. If deduction is allowed on payment basis, if expense can be claimed on payment basis, there is nothing outstanding. Whatever you pay, you take the expense or you take the benefit. So, carrying amount of liability for the purpose of tax would be 0. So, carrying amount for the books is 20,000 for the purpose of books. For tax purpose, it is 0. This is called tax base. Right. Now, in year 2, what happens? In year 2, expense for the same transaction for accounting is 0, for tax it is 20,000. Liability 0 and 0. Why 0? Because nothing else is payable in respect to that year, in respect of that year 1 expense. Now here, what the standard or what we will be learning is, this carrying amount of liability as per books and the tax base, there is a difference. Carrying amount of liability as per books and the tax base, there is a difference that results in a temporary difference. Right. Now, how to calculate deferred tax liability and deferred tax asset, that we will be dealing with subsequently. But one more thing that you need to understand is, when I am claiming expense of 50,000 in year 1 for accounting purpose, the tax impact of that entire 50,000 must be given in year 1 itself. So, that tax impact comes by the way of direct current tax as well as deferred taxation, right. Then, let us take another example. Year 1 expense, let us say payment to, or I would rather say provision. Okay. Expense, provision for some employee benefit, some specific employee benefit. Again, all of these will be given to you in the examination. So, you don't need to worry about whether we should know the tax laws in detail or not. Okay. So, let us say accounting expense is 20,000. Amount paid is 30,000. Amount paid is how much? 30,000. Now, in that case, what do you call the difference between the expense part and the amount paid part? Expense is what is there, what I have accounted in my books. Amount paid is amount actually paid. What is this difference called?
Advance.
It can be advance. Okay.
Unrecognized expense.
Unrecognized expense. I was expecting more simpler answer actually.
Asset.
Correct. Which asset? I think for basics we have forgotten. We call it prepaid expense, right? We can call it advance paid also. That's not a problem. It's not a provision because we have paid extra. Expense is 20,000. I have paid extra. See, if amount paid is 10,000, then it would be a provision. But here I have paid 30,000 in by way of bank. So if I have paid 30,000, my prepaid expense is 10,000. This prepaid expense is what? Is carrying amount in accounting, which is 10,000, right? Now, the tax laws say deduction as expense on payment basis. So, for tax purpose, how much is the expense? 30,000 is the expense. Yes, 30,000 is the expense. How much amount we have paid? We have paid 30,000. How much is the carrying amount or prepaid expense for tax? It is 0. So here also, the tax base is 0. There is an accounting base of 10,000, right? So, for every item, we have to calculate the accounting base and the accounting carrying amount and the tax base, and based on the difference we have to calculate whether it is a deferred tax asset or a deferred tax liability, right? So in today's discussion, just to summarize whatever we have done so far, we have understood current tax, which is tax payable based on current tax provisions or current tax laws. Then we have understood about deferred taxation concept, the concept of temporary difference and permanent difference, right? Now, there would be a lot more in calculation where we will be able to understand when is it a deferred tax asset and when it is a deferred tax liability. So, example of temporary differences could be certain types of income and expenditure that are taxed on a cash basis rather than accrual, difference between non-current asset depreciation and the tax depreciation. So this is another temporary difference, right? That is one thing. And for these differences, we recognize a deferred taxation.